When does a 2% dividend-paying stock beat a 5% dividend? What's the payout ratio and why should you care? And what are the two most important days of your life? We'll answer these questions and more on this, the 116th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, I am excited today because I'm finally getting back to a series I started what seems like eons ago on dividend investing. And gonna have what will be the third installment in this series. And I'm actually looking at my growing list of episodes to see when I actually recorded the first and second in this series. Looks like it was all the way back at number 96 and 98. So if you haven't listened to those, you can. DoughRoller.net/podcast 96 and podcast 98. You'll find the show notes to both of those episodes as well as the audio. Actually, too, I've had a number of people email me about how bad my website is. If you ever go to DoughRoller.net, maybe some of you listen to this podcast, you've never actually been to the blog, but it's at DoughRoller.net, and you'll see in the navigation there at the top, there's a link for podcasts. And if you go to it, you'll see all the podcasts, but they are in pages with just 10 on each page. And so, excuse me, if you scroll through it, this, right, I'm looking at it now, it starts at podcast 113 and goes down to 104, then you have to hit the next page, and you have to keep paging through. And I've had a number of people over the last few months email me and say, that's not really the most user-friendly way. So I am working on a new tool that I actually purchased and I have to implement. I'm hoping to do that, hopefully, actually, by the time you listen to this podcast, because I do record these a few days and in some cases even a week before I publish them, by the time you listen to this podcast, I will have it up. I will have it working. That's my promise to you. And if you listen to this podcast and you go to the page and it's not working, then you can email me and tell me I'm a loser. But that's my goal, so that you won't have to scroll through page after page after page to see all these shows. Of course, you can also just go to the show in iTunes, and I have an easy redirect link for you. If you just go to DoughRoller.net/iTunes, it will redirect you to the iTunes page where my podcast resides, and you can subscribe to the podcast, which I would be grateful, and you can also leave a review there, which I'd be grateful, but you can also see them all in one easy place. But I will have this page looking better than it does now by the time you listen to this podcast. That's my goal. So we've got a number of things to cover. As I mentioned, this is going to be the third installment in the dividend series, and my goal for today in terms of the main topic, I have just one goal, and that is to convince you that a higher dividend is not always the best when it comes to dividend-paying stocks. That's my goal. That's what I'm going to try to accomplish today. I always talk to people, and they like to say, well, this stock's paying 4% or 5%. And I think, well, that's fine, but there's something else you should be aware of beyond just the yield. And that's what we're going to talk about today. Before we get to that, though, a couple of email that I want to read to you, a couple that are unrelated to the main topic, then one that is, or two that are, I guess. The first one comes from a listener named John. Here's what he said. He said, I've just had a few thoughts lately listening to your podcast. Since I started my job and started looking at my 401k plan and listening to your podcast, I believe I have developed sort of a passion for investing in finance matters. I want to learn as much as I can and help people my age in understanding their options because most have no clue. So it got me to wondering, seeing as you have a law background, how did you get into finance and investing? What inspired you? How have you gained all of your knowledge? I'm really just wanting to know your story. If there's a podcast on this already, please direct me to it. Listening to you taking the Series 65 exam, it seems that I might want to make that a goal of mine one day later in life. So I was wondering if you could share how you got to where you are now and how you gained all of your knowledge over the years. If you are too busy for that, I totally understand. Hope you enjoying the great hospitality of South Louisiana. That's when I was in New Orleans this weekend. If not, at least I hope you're enjoying the food. Look forward to hearing from you. Well, Louisiana was wonderful. New Orleans is Very interesting place. One thing about New Orleans is when you're downtown, it's a totally different place during the day than it is at night. If you've never been there, you can only imagine. But it was a wonderful place, and the food was fantastic. The people were great. Great email, John. It never really occurred to me to do a podcast about me. I don't know. So I thought, well, I can do that. That's not going to be today. I can kind of give you my story for what it's worth. But then I had an idea. I was actually talking to a few other friends of mine. And I thought, so I'm going to throw this out there. If anyone listening to this wants to interview me for a podcast, I will let you turn the tables on me. So if you're interested in that, shoot me an email at dr@DoughRoller.net. I'm looking for someone who has got some great questions, for me. You can quiz me. I don't care what you ask me. Well, I probably do care what you ask me, but, about finance and investing. I may not get any response to that offer. And if I don't, that's okay. I'll just maybe come up with a show where I just talk about myself for 30 minutes. But if there's anyone out there that wants to, come on the show, it'd be a phone call. I'll record it, of course, and you can ask me whatever you want about my background in finance and investing. I will do my best to answer your questions. If you're interested in that, like I said, email me at dr@DoughRoller.net. And in the email, I don't know, give me 3 questions you might ask me. You're going to obviously ask me a lot more than that, but I just want to kind of get a feel for the kind of questions you're going to ask me. Beyond that, I'm not going to ask for the questions up front. There'll be no rehearsal. There'll be no practice. It'll be, I call you, I hit record, and you just start asking me questions. But in the email, if you're interested, shoot me 3 questions you might ask me just so I can get a flavor of the kind of questions you might ask. And if more than one person does it, I'll pick somebody. I don't know how yet. And if no one does, that's fine too, John. I will record a podcast at some point in the near future about how I got into this crazy business. Okay, on to the second email. This one comes from a listener named Will. He says, first, I wanted to thank you for your podcast. I find it an excellent resource for many financial topics. I asked this question to the guys at Stacking Benjamins. Let me stop there. Stacking Benjamins is a great blog and podcast. You absolutely should check it out. Joe over there is fantastic. I was with him at FinCon in New Orleans not long ago, and they do a great show. Very funny, very informative. I like it a lot, so definitely check out Stacking Benjamins. And a great name. I like the name. Anyway, he says, I asked this question to the guys at Stacking Benjamins and would like to get your perspective on my situation as well. I really respect your opinion, and I just wanted to make sure I am on the right path or if I am missing something. I am 33 and will finish paying my house off in 19 months. Wow. I have chosen to pursue paying off my house due to some special circumstances with my job. My current income is roughly $80,000 a year. I currently contribute 22% of my salary, including matches, to my 401k. My goal is to become financially independent, not retired, financially independent by age 40. After the house is paid off, I want to create some income streams through investments with the money I would otherwise have paid on my mortgage. These streams would be outside of retirement accounts and would replace my income during the times I choose not to work after 40. The goal is to create enough income sources so that I never have to touch any of my nest egg. I would most likely continue to work, but would like the flexibility to do something crazy, like take the whole summer off to spend time with my kids or travel, work with a nonprofit, etc. I will invest in a portion of the money in index funds and possibly dividend stocks. Well, that's good. That's our topic for today. And continue to grow my lending club portfolio, which, by the way, has done very well. I also have a merchant services business, ATM machines primarily, that cash flows nicely. Rental properties may be an option, as this is something I invested in years ago and have familiarity with. I am considering a mix of REITs, high-yield bonds, and municipal bonds, along with the aforementioned dividend stocks. Aside from these investments, are there any alternative investments you would consider for generating income? Wow. So my first response is that Will really should be behind the mic recording this podcast and not me. I mean, the guy is 33, going to have his house paid off in less than 2 years, financially free at age 40. This guy has got his financial act together. In terms of answering his question, here's what I told Will. I responded to the email. And my response was, look, I can't fathom that you need any more alternative investments. I mean, let's walk through what he's mentioned. Index funds, good. Dividend stocks, love it, right? Lending club portfolios. Lending club is a peer-to-peer, person-to-person lending website where you can borrow or invest in loans. And I've mentioned it before. I have an account, not a significant account, but I have an account at Lending Club as well as Prosper. It's another similar company. He has his ATM machine business, so that's interesting. It never really occurred to me that there could be an ATM machine business, but I guess there can be. By the way, I have a fond memory years ago of meeting someone. I was so jealous. He had a business of payphones. He owned a bunch of payphones he'd put up, at convenience stores and whatnot, and it made a full-time living. And I was kind of just so jealous that he was, had this good business, and it seemed to kind of had a free lifestyle, and I just was, I guess jealous isn't the right word. I was impressed. Of course, then the cell phone came along and basically wiped out his business. So hopefully, I haven't seen him in decades, but hopefully he adapted. Anyway, he's got rental properties, REITs, which real estate investment trusts, high yield bonds, which are the same thing as junk bonds, but they're loans to companies that have higher credit risk, so you get a higher yield. And municipal bonds, we've talked about those. Those have some tax advantages, so those are good to hold in a taxable account. So I said to Will, look, you don't need any more, from my opinion, you don't need any more alternative investment suggestions. You got plenty. My only suggestion was that he focus on total return, not dividends and interest. You need to look at total return, which includes capital gains, right, or appreciation of the value of the underlying business or stock. And so that was my suggestion to him. I think if you get too focused on just the dividends and you don't focus on the growth of the underlying investment, you could end up actually being worse off, which is perfect for our topic today because it's exactly what we're talking about. So that was my tip to him. He did respond back and say that basically that was the same. It just turns out to be the same suggestion that the folks at Stacking Benjamins had for him. So I guess great minds think alike, or I don't know, maybe not so great minds think alike. But I guess they had the same suggestion to him: is focus on total return, not just the dividends and interest from these investments. And that, like I said, is a great segue into today's main topic on dividends. Again, it's our third in the series, and it's focusing on the yield of dividends, but also what is so important is the underlying growth. That's what we're going to talk about. And to kind of lead it off, I've got another email from a reader. This comes from a reader named George. He writes in, he says, as you may know, Apple recently started paying out dividends. When you see a company like this that didn't pay out dividends for some years because it was growing quickly, do you view this as if management thinks they have reached some plateau and they don't expect to keep growing as fast as they have been? So that's a great question and perfect for today's topic. So let's kind of think about the life cycle of a company, and then I'll give you some specific examples of companies that are that are in these different sort of phases. You think about a new company, a relatively new company. Maybe they've got a new product, they've innovated, and they're growing. Whether they're doing a lot of research and development and building new products, perhaps they're growing in locations. They're a retail store, and they're opening up and expanding into new areas, new territories. They need every dollar of cash they can, every dollar they can get their hands on. So anything that they're making, all their cash flow, they're reinvesting back into the business, again, for research and development, to create new products, to expand into new territories. And as an investor, assuming that they're doing this in a smart way, it's exactly what you want them to do with their money, because as an investor, that's what's going to get you, hopefully, the greatest return on your investment. Again, this is for a company that's doing well, that's growing, so they're not paying a dividend. They need to keep every dollar they can and reinvest it back into the business. As a company matures, its ability to smartly reinvest money back into the business starts to diminish. Maybe they've already expanded into all of the territories where it makes sense for them to expand, or they've already expanded into different product categories, and it doesn't make sense for them to expand beyond that. And so what happens is they don't have as many ways to wisely put their money to work, and so cash starts to build up. Now, this is when things are going well, right? We certainly know that businesses can go under, but when a business is doing well, once it kind of saturates the market, it doesn't have the opportunities that it once had to invest its cash, and so cash starts to build up. And eventually, they have a choice. They can either return some of that cash to investors, typically in the form of dividends. They can also do it in the form of share buybacks, but we're talking about dividends today. So they can start to pay dividends. That would be the good way, I think, to use their money once they've saturated the market that they're in. Unfortunately, sometimes management will choose to do some really stupid things with their cash. And they will decide that they want to continue to grow, even if it doesn't make sense. And they expand into markets where they really have no business expanding, or they try to go into totally different product markets, where that's just not their core competency. And usually, or oftentimes, by the way, they'll do that by buying other companies. And oftentimes, that turns out to be a very bad deal for investors. Not always, but quite frequently. But the point is, once they've saturated their primary markets, and they start to build up this cash, companies will tend to start paying a dividend. And to George's point, yes, that can suggest that their growth will slow. That doesn't necessarily mean it's a bad investment at all. But yes, they may not be growing as quickly as they once were. You can take that to a further extreme, to some companies that pay a dividend and have very, very little growth. But just because a company pays a dividend doesn't mean it's not growing nicely. But it could mean that it's not going to grow as quickly as it once did when it first entered a new market. Or again, if you're talking about a product company, he mentioned Apple. They've sort of saturated the cell phone market, and there's a lot of competition. And they're certainly coming out with new products. They obviously just came out with the iPhone 6, and they've announced the Apple Watch. Excuse me. So still haven't completely gotten rid of this cough. So yeah, their growth probably will slow. That doesn't make it a bad investment, but it is a point to note. Their growth probably will slow. Most people think it will. Their margins will start to and have started to diminish some because of competition, among other things. So yeah, that is likely to happen. And that's pretty normal, in the life cycle of a company. And if you kind of think of it this way, is how I think of it. You have growth versus income. So you think growth, that's the Apple before they were paying the dividends, and they were growing their revenue, growing their earnings. And then over time, that growth starts to slow, but they start to build up a lot of cash, and then they start paying dividends or current income. And what I have found is that there's this tension between growth and income, and it's true in any investment. Let me give you an example. So, as I think I invest in single-family homes in Central Ohio, where I'm from. And what I've found is that with real estate, if you buy a home that is in an area where you think the value of the home will go up quickly, what you find is that the current income, the cash flow on that property isn't so great. And the reverse is true. If you can find a home where it can cash flow very nicely with very little down, chances are you won't expect the value of the property to go up quickly. That's basically the kind of real estate I invest in Ohio, where we can finance 100% of the purchase, including the rehab costs, because we buy foreclosures that sometimes are in pretty rough shape. We can cash flow with zero money down. But these homes are not going to go up in value quickly. They're just not. Now, the reverse of that would be in Northern Virginia, where I live now. You cannot do that. You cannot buy a single-family home in Northern Virginia, finance 100% of it, and expect to have a positive cash flow. It won't happen. You won't come close. But I would expect the value of the homes in Virginia to go up much faster than they will in Central Ohio. Again, over the long term, obviously, we've seen that home values can go down in the short term. But over the long term, so there's this tension between growth and income, and that's often true with, I think, any investment where, the more growth you have, potential, oftentimes you have less income. The more income you have, you tend to have less growth. Let me give you some examples. Let's start with an example of a growth company, and one I've mentioned before, Tesla, the electric car maker. They are expanding. They're building new cars. There are plans to build what they've called the Gigafactory, where they're going to build batteries, manufacture batteries. They are in a perfect example of in a growth phase of the company's history, where they need every dollar they can get their hands on. They are not anywhere near ready to pay a dividend. They have no current plans to pay a dividend. They're going to be reinvesting every dollar they make back into the company to innovate, to build new cars, new models, the Gigafactory, as they call it. And a perfect example of a growth company. We don't know what it's, how it's going to work out. It could end up being a success. So far, it seems to be pretty successful. It could continue or it could flop. We don't know. That's one of the downsides to a growth company. They're exciting. They make the headlines. They're growing. But there's a lot of uncertainty. We don't know what the future is going to hold. So far at Tesla, as far as I can tell, and full disclosure, I own the sum total of one share of Tesla. But we don't know what the future is going to hold for the company. But it's an absolute growth company, and there is at least the potential for investors to make a heck of a lot of money. Of course, you might lose a lot too. But that's a perfect example of a growth company. As it then turns to a more mature company, to where it's sort of saturated its market and begins to pay a dividend. You can still see growth, but usually, as George pointed out in his email, it does slow down. Apple would be the example I would use there. They started paying dividends, I think, 2 years ago, thereabouts. And still, I think, a great potential for growth, but not on the order that we saw, over the last decade. Probably pretty unlikely. But from an investor's perspective, there's a little more certainty to its path. That doesn't mean it's not without risk, but it has a lot more history and a lot more developed products and markets than, say, Tesla does. So, you don't have quite the same level of uncertainty about its future as you might with a newer company like Tesla that's in a pure growth mode. So it's more established, a little more certainty, still plenty of risk, but a little more certainty, and a nice dividend that investors receive for their investment. And then you could take a company where it pays typically even a higher dividend yield, but has even less growth. And a perfect example there would be a utility. They are companies that require a lot of capital to run because of the equipment. They're highly regulated, of course, and they tend to pay higher dividends, a pretty good yield, but you're going to see much less growth. You're not going to see a lot of growth in a utility. Again, it doesn't make it a bad investment; it makes it a different investment. There, you have even more certainty than you do, say, with Apple. But you're also, in exchange for that greater level of certainty, again, it doesn't mean risk-free, but there's certainly, I think, more certainty in a typical utility investment than with, say, something like Apple. You get the higher yield, but you get much lower growth potential. And then the fourth one I would mention is one where you get typically a pretty good yield, but zero growth, absolutely no growth whatsoever. You say, well, what in the world is that? U.S. government bond, right? The 30-year bond today is paying, I think, just over 3%. Now, that's obviously historically low, because of the current interest rate environment. But putting aside the actual yield at the moment, you can lock your money away for 30 years. It will not grow, but you'll get this yield, and it's guaranteed. It's as guaranteed an investment as you can find today. As risk-free an investment as you can find, at least in terms of loss of your investment. But there you have zero growth, but you have guarantees. So you can kind of see the spectrum between growth, all growth at one end, Tesla, a combination of growth and income at Apple, and then even more income but less growth at a utility, and then finally all income and no growth at a U.S. government bond. And so you can kind of see the dynamic in play there. Now, one question might be, well, which one is the best investment? Well, they all have different purposes. They all serve different purposes. Typically, you diversify and you have a little bit of all of those, right? Because you're not, we're uncertain as to the future. So that's sort of the dynamic between a growth investment versus the income from an investment, and the interplay between the two. And that brings me to a story I want to tell you. Imagine you're retiring, you're 65, and you're planning, of course, none of us know how long we're going to live, but you're planning for a 30-year retirement. And you have $1 million. That's your nest egg. You're going to get some Social Security, and you're following the 4% rule. That is, you're going to withdraw 4% in year one in hopes that your money will last for 30 years. So 4% of $1 million is $40,000. And you have an investment, and you can invest all $1 million, and it just so happens to pay a yield of 4%. Perfect. Now, there's no growth, but you're getting a yield of 4%. Wonderful. Perfect. So you invest your money, sure enough, in year one. You get your $40,000, you add that to your Social Security, and you're enjoying retirement. Everything is fine. Now, what happens in year two? Well, remember, there's no growth in this investment, so you get your $40,000 again. That seems fine, right? Except we do need to factor in inflation. And we don't know what inflation is going to be exactly. We can estimate it. Obviously, it fluctuates from year to year. If you look back over the last 30 years, it's fluctuated wildly. I can remember double-digit inflation. But more recently, it's been quite tame. We could assume 2%, right? So we could say, okay, well, what is 2% of $40,000? And we need to add that to year two, right? And the idea is we want to keep the purchasing power of our money. And so to do that, we have to adjust it for inflation. 2% of $40,000 is $800. Not a lot, $800 for a year. It's just over $50 a month. But now you need $40,800. Well, now we see a problem with our no growth investment. It's not going to pay us $40,800. It's only going to pay us $40,000 a year. That's it. So we have some choices to make, right? Well, one would be we'll just stick with the $40,000. We won't take out $40,800. Yes, our money won't buy as much as it did the year before, and we'll just make some sacrifices. And that's a perfectly valid choice, at least in year one, right? Although if we start to think about it, we think, wait a minute, we've got to make this last for, let's see here, 30 years. How are we going to do that? Is that going to become a problem eventually? Well, we can do the math, right? We've done this before. Just break out the old Excel calculator. And if we assume just a 2% inflation rate over a 30-year period, by the end of that 30 years, we'll need, drum roll, over $72,000 30 years from now to buy what $40,000 buys us today. And that's assuming a 2% inflation rate. We can start playing with that. If it's 2.5, it goes up to $84,000. And what happens if it's 3%? Well, then it goes up to $97,000. And I know the Fed is trying to keep inflation at 2%, but historically it's been a lot higher than that. If it averaged 5%, forget about it. We're at $173,000. Inflation will eat away at that $40,000 so fast, we'll have a real problem on our hands. So that's long term, even at 2%. That's really not going to work. And it might work for a year or two or three or five, but eventually that $40,000 it's going to really be hard to make that work in retirement. Another option would be to start drawing down the principal. We've got $1 million invested, so maybe we take out the $40,000 from the yield, from the interest, but then start chipping away at that $1 million. Now, that in and of itself wouldn't be a problem, potentially, if we saw growth in that $1 million, if it too could grow. But in this example, it doesn't. So chipping away at the principal could cause us to run out of money during retirement. So it's a real big problem. Now, you might say, well, wait a minute. What kind of investment why would you ever agree to that kind of investment where you put $1 million away, it doesn't grow. You get a 4% yield, which seems okay, but it doesn't grow. Why would you do that? Well, again, we've talked about it. That's a U.S. government bond, right? That's a 30-year bond. Actually, they're not quite paying 4% right now. As I mentioned, it's actually worse than that. I think it's 3. Let's see here. I can tell you what it is exactly. 3.14%. That's what it's paying right now. Now, again, historically low. I assumed 4%, a little higher. But you can see the problem where you have an investment. It pays, in our example, a decent yield. 4% is not bad. But with zero growth, it can create a huge problem, in this case, in retirement. And that's really the point that I want to underscore today is this: when you're investing when you're investing for dividends, in part, whether you're in retirement or not in retirement, looking at the yield is fine. Yield's important, but it is only half the story. You absolutely have to look at growth. Now, here's the interesting thing. When you're dealing with fixed income investment, think of a certificate of deposit. The higher the yield, the better. It's easy, right? You compare 2 5-year CDs. Yeah, you have to look if there are any fees. Let's assume there aren't. But beyond that, it's a simple analysis. The one that pays the higher yield, the higher interest, is the one you're going to choose, right? That's true whether you're looking at a certificate of deposit, a savings account, maybe an interest-bearing checking account, or a bond of any kind, right? Now, again, assuming with bonds, we also have to look at the risk of default, but let's just assume we're talking about U.S. government bonds that are considered risk-free. You know, if you're looking at a government bond, you want to get the highest yield you can get. And that's generally true with fixed income investments, again, particularly those that are risk-free, like a certificate of deposit that's FDIC insured or a savings account. It's pretty simple. Higher yield wins. With stocks and dividend-paying stocks, whether, again, it's individual stocks or a mutual fund, an ETF, you can't just look at the yield, because with stocks, you also have to look at growth. And in fact, a lower-yielding stock that is going to enjoy higher growth can be more valuable in the long term than a higher-yielding stock with little to no growth. So with stocks and stock dividends, it's not just the yield. And remember, the yield is the dividend it pays out each year divided by its price. You also have to look at the growth in both the dividend itself, which we're going to talk about here, but also growth in the underlying value of the stock. And we can take Apple as an example. Hopefully, its iPhone 6 is a success. Hopefully, they figure out that they're not bendable, or if they are, they can fix that little problem. Hopefully the Apple Watch does well, and they grow their earnings. Right, so the value of the stock is going up, and they can increase their dividends. That's the hope. That's the goal. So again, the key is you have to look at growth, not just the yield itself. So doing this is pretty easy. I'm going to walk through how I do it, and it's not hard at all. The first thing we need to look at is this: when we're talking about dividend growth, we're talking about the actual amount of the dividend. We're not talking about the yield. So, for example, if a company in 2013 paid out $2, right, then we're looking, okay, well, what did they pay out, or do they plan to pay out in 2014? Is it going to go up? Maybe it's $2.10 or $2.20. When we're talking about growth, we're looking at the actual dividend payment, not the yield. Why is that? Well, remember, the yield is not just a function of the dividend payment. It's also a function of the price of the stock. So you can have a company that's regularly increasing its dividend year after year after year, and the yield doesn't change much. I mean, certainly in a bull market or a bear market where the stock price is changing dramatically, the yield will change. But let's just say in a pretty stable market, as the dividend payments go up, presumably the company is continuing to earn a nice profit, paying out a little bit more each year in dividends. What's going to happen to the stock price? Well, again, it's going to presumably go up as well. Again, you could have a bear market, but putting that aside, it's going to go up as well. So the yield might not change. Actually, the yield, in a bull market, the yield could go down, right, if the price goes up. So when we talk about dividend growth, we're talking about the growth in the actual amount of the annual dividend, not the dividend yield. Now, how do you get this information? Well, there's a lot of ways to do it. My favorite, as I've mentioned many, many times, is Pepsi. Pepsi is Morningstar. I said Pepsi because I'm looking at the Pepsi chart in Morningstar. Morningstar. So I mentioned Pepsi. Let's look at it right now. You put Pepsi in the quote box. PEP is the ticker, and I own shares of Pepsi. You can pull it up, and it'll give you a quick quote of the stock. And if you just go to key ratios, which there's a tab for it, you can see their dividend payout, in this case, going all the way back to 2004. So I can see their dividends, and right now, if we go back to 2004, it was 85 cents for the year. And then in 2005, it went to a buck and a penny. And then it went to 116, 143, 165. All the way up in 2013, they paid out $2.24. So far, trailing 12 months, $2.36. So what you see is every single year since 2004, and we could go get even more historical data if we wanted it, but this is fine for today, we can see that they've increased their dividends year in and year out. And what I do when I'm investing in a stock is I will chart these payments. I just use Excel. I'm looking at my spreadsheet now for Pepsi, and I create a column for each year. And mine happens to be based on Morningstar, so I simply went back to 2004. And I put in the amount of the dividend all the way through to 2013, and then I calculated from year to year the growth. So from 04, it went from 85 cents to 05, $1.01. That was an 18.82% increase. And I calculate that increase going forward all the way through the most recent data. I take an average percentage growth for that dividend, which is 10.5%. Which is a healthy growth. Now, it's interesting. I also look at trends. In more recent years, the growth has slowed. So while it was 18% in 05, it was 15% in 06. 2007 was 23%, but then back down to 15% in 08. But then 8% in 09, 6%, 7%, 5%, and then finally 5.16% in 2013. So it's slowed down. And so what I'm looking there is I'm looking at the growth. I want to know what it is. And then if I see things like the slowdown, I want to understand why. And, so I'll dig into the financial statements. I'll dig into management. I'll listen to the earnings calls. Again, all to try to understand what's going on with the growth in this company. But that growth pattern, whether it's good or bad otherwise, is as important to me, if not more important, than the actual yield itself. And the other thing that I do is I compare its competitors. So on this spreadsheet that I'm looking at, I also have Coca-Cola. And I list their dividends going all the way back to 2004. And I look at their dividend growth. Their dividend growth historically is a little different. It's been a little higher more recently than Pepsi, although their average growth, if you go all the way back to 2004, is basically the same. Pepsi grew at an average rate of 10.39%. Its dividend, Coca-Cola grew at 10.5%, 10.5%. So I'm looking at this growth to understand. I want to compare it to their closest competitor or competitors, and then I want to look again at the trends and historically, are they raising their dividends each year, and if so, by how much? And that's all there is to it. I mean, it's pretty simple. Now that's not all you look at when you're evaluating a stock. Of course, this is just one part of it. But, again, the recap is you look at actual dividend payments, not the yield, to understand growth. Morningstar is a great tool to find this information very quickly. I tend to spreadsheet that data just as a way to see it in one place, but also to show the growth from year to year. And then I look at their competitors, and I see how their competitors are doing. And you start to ask some tough questions. Why is a competitor doing better or worse? Why is the yield in the case of Pepsi gone down in recent years? What's going on there? Oftentimes that will cause me to look at their earnings per share and the growth in their earnings per share. How's that been? How does that look? Because ultimately dividends are paid, hopefully, out of profits, out of earnings, right? And so if the dividend yield is going down, do I also see that earnings per share are going down? And why is that? Or if the growth is rising in the dividend payment, do I also see a rise in earnings per share? And so again, the real takeaway from this though is that the growth in a company's earnings and the growth in its dividend payments is as important, if not more important, than the actual current yield. If you take nothing away from this podcast, please take that away. It's so important. And it leads me to the last thing that I want to point out in this third of a series of dividend investing, and that is something called the payout ratio. Because if you just look at the increase in the dividends, let's say you see a nice increase from year after year and you see good growth. For example, in comparing Pepsi and Coke, Coke's increase from year to year has been a little stronger than Pepsi's, at least in recent years. In 2013, Pepsi increased their dividend by, as I said, just over 5%. Coke increased its dividend by just under 10%. Not quite, but almost twice as much. And the same is true in 2012. Pepsi increased their dividend by just under 5%. Coke increased their dividend by 8.5%. Here's the thing. You can't stop with that analysis. Obviously, you've got to look at earnings per share as well, but you also should look at the payout ratio. So what's the payout ratio? It's a ratio that's easy to calculate. You take the dividend per share that they paid in a given year, divided by their earnings per share. And what it tells you is it's simply the percentage of its earnings that a company pays out to its investors, its shareholders, in the form of a dividend. And so, again, this is reported in Morningstar. In fact, the payout ratio you'll find right underneath the amount of the dividends. So if I go to 2013, Pepsi paid out 51.8% of its earnings per share in the form of dividends. If I compare that to Coke, Coke paid out somewhat more, 58.8%. So that could, you'd have to do the math, that could account for at least some of the reason that Coke increased its dividends in 2013 by a greater percentage than Pepsi did. It was paying out more of its earnings per share in the form of dividends. Now, you could say, well, is that a good thing or is that a bad thing? Well, here's the thing about the payout ratio, a couple things to keep in mind. A very high payout ratio could be problematic. I'm not saying 58.8% is too high. Think more like 70, 80, 90%. If you have a company that's increasing their dividends each year, but in order to do that is each year paying out more and more and more, a higher percentage of its earnings, what that can tell you is it's not sustainable. Eventually, they're going to run out of earnings to pay out in dividends, and they're not going to be able to continue to increase their dividends. So a very, very high payout ratio can indicate that a company is, trying their best to continue to increase their dividends from year to year to keep investors happy, but maybe their earnings per share are just not where they need to be to keep up that pace, and it's going to eventually be a problem. A payout ratio that's too small could suggest that a company, is not paying out as much as they should in dividends, and that raises the question, well, then what is it doing with its earnings? And is it doing smart things with its earnings, or is it doing, as often is the case, dumb things with their earnings? And so that's something to look at as well. Now, of course, you say, well, that's great, but what's too high, what's too low? Well, there's no easy answer to that. One of the things I look at two things. One is trends. What's their payout ratio been historically? If it's changing for higher or lower, why? And is it changing significantly from what the company has historically paid out? And if so, why? And then the second thing I look at are competitors. What are the competitors doing? Again, with Pepsi, easy competitor, Coca-Cola, is it paying out significantly more or less of its earnings than its competitor, and why? And what has its trend been? Now, when I look at Pepsi and Coke, Pepsi paid out 58.8% in 2013. Pepsi paid out 51.8%. So it's a difference of 7%. To me, that's not significant. And if you look historically, it's consistent with trends that you're seeing. I mean, in the case of Pepsi, 10 years ago, they paid out 35%. And it's steadily increased to where it is now at roughly 50%. And, Coca-Cola, though, interestingly, has consistently paid out roughly 50%. 58.8% is actually its highest in the last decade, although trailing 12 months are actually 62.5%. So there'd be some questions to ask there. Why is it rising to where it is? But the real key takeaway is, don't stop with dividend yield, look at growth. And once you look at growth, don't stop there. Look at the payout ratio to make sure the company isn't struggling to increase its dividends from year to year without seeing comparable growth in earnings. So again, if you take nothing away from this podcast, take this away. The dividend yield itself is only half the story. At best, you have to look at growth. And again, an extreme example of that would be comparing a company like Apple, which hopefully will continue to see some growth, with a U.S. government bond where you invest your money. You see absolutely no growth in the money you've invested, and the yield that you get back will stay the same as well throughout the life of the bond. Again, that doesn't make a bond a bad investment. It makes it a different investment. But when it comes to dividend investing, when folks are looking for good, solid, dividend-paying stocks, don't just look at the yield. You've got to look at growth. Okay, on to the tip of the day. This is really more like a quote of the day, I guess. And here it is from Mark Twain. The two most important days in your life are the day that you were born and the day you find out why. I came across this quote just the other day. It really struck me. I think I'm still trying to figure out why. Maybe we all are. I hope you've figured that out. If you haven't, don't stop asking the question. I think it's an important one. Hey, I hope you have a great day. If you have any questions about this podcast, topics you want me to cover, whatever, shoot me an email, dr@DoughRoller.net. And if you're interested in interviewing me on this show, turning the tables on me, remember I mentioned this at the top of the show, shoot me an email with 3 questions you'd ask, again, just to give me a flavor of kind of who you are and how you'd approach it. And if I get someone, I'll open up the lines and let you quiz me for 30 minutes or whatever. So if you're interested in doing that, turning the tables on me, just email me at dr@DoughRoller.net. Hope to hear from you. As always, love to get your emails. Hey, until next time, remember, the best thing money can buy is financial freedom.